Welcome to this Monday edition of Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. India's largest private banks, HDFC and ICICI, posting better than expected quarterly earnings amid stronger loan growth, but margin pressure and bad loan provisions were also on the rise. Prime Minister Narendra Modi heads to the UK this week, where he's widely expected to seal a trade deal there, as India also races to do a deal with the United States. US Commerce Secretary Howard Lutnick saying August the 1st is a hard deadline. And Japan's uphill task to get a trade deal with the United States just got even tougher after Prime Minister Shigeru Ishiba's ruling coalition faced a drubbing in Sunday's parliamentary elections. Fair bit of dispersion in these Asian markets as we kick off a new trading week here in the region. At the losing end, we got Australia down by 1%. Taiwan is giving up the ghost as well, down by 0.2%, but we are seeing some strength in North Asia, in the Hang Seng, Shanghai Composite and the Kospi. One of our top stories today, you're not seeing any quotes, by the way, for the Nikkei because it is closed, but futures are suggesting that the markets will hold their ground despite the result over the weekend. And let me just remind you, the ruling coalition lost control of the upper house during elections in Japan on Sunday. Indian markets will be joining us in about 45 minutes' time. Let's give you gift nifty futures and see what they are pretending for the benchmark. We are looking at a pivot just below the 25,000 mark. 25,000 on the nose is what nifty futures are expecting and indicating for the open. Where we left off on Friday was rather grim, because remember that we are in the thick of earnings season, and it was the key financials and the IT companies that did disappoint, and both the private banks and the heavyweight financials led the losses on Friday's session, pardon me. Now, the Indian Parliament opens its monsoon session today. Key bills are on the agenda, including the personal income tax changes announced in this year's budget. Lawmakers will also debate the Mines and Minerals Amendment Bill, which aims to streamline the rules for exploring the country's rare earth reserves. Session is expected to have a stormy start, with the opposition set to grill the government over Operation Sindoor. That's the military operation conducted in the aftermath of the Pahalgam terror attack. Pivoting to earnings now, some of India's top private banks reported Q1 results over the weekend. First up, HDFC Bank, that's the country's biggest private lender by market cap, posted a 12% rise in profit. Profits rose despite a five-fold jump in provisions for bad loans. Strong treasury gains and robust loan growth lifted net interest income by over 5% last quarter. In the meantime, some margin pressure over at ICICI Bank, with net interest margins falling to 4.34% from 4.36%. A year ago, banks still reported a 15% jump in profit, beating forecasts thanks to healthy loan growth. At Yes Bank, profits surged about 60% year-on-year, boosted by strong non-core income. Remember, Japan's Sumitomo Mitsui is currently in talks with the Reserve Bank of India to raise its stake in Yes Bank to 25%. Let's get a deeper dive on what we've learned so far on earnings season and how the banks are shaping up, and bring in Santanu Chakrabarti, India's banking, financial services and insurance analyst at BNP Paribas. Santanu, thank you very much indeed for joining me on Inside India. Dalal Street prefers the NBFCs during this rate-cutting cycle. You, however, are taking a contrarian approach and prefer the banks. Why?
So, first of all, a very good morning. The reasoning is very simple. We feel that NBFCs, for the most part, are a much more crowded trade than the large private banks. Now, there is a definite grain of truth to the fact that, the moment rates get cut, initially margins for private banks or any other bank will suffer, because a portion of the loans is definitely floating rate. In fact, many cases linked directly to the policy rate. For NBFCs, which have mostly fixed rate loans, the opposite is true. You might get a small benefit to margins. But we think not only is this reflected in the relative valuation, it is perhaps a highly overdone and tired theme. To give some context on how sensitive exactly NBFCs are to this phenomenon, let me propose to you the average spread / net interest margin that an NBFC makes. Typically, it's between 800 to 1,000 basis points. Now, are we really saying that, repricing on 40% of their liabilities worth about 50 basis points, maybe totaling to 20, 30 basis points over a 2-quarter period, that boost, which, by the way, will go with certain repricing downwards in the asset side as well, is so meaningful on earnings that that's the only thing we should be predicated on. And similarly, in the case of banks, yes, it's very true that initially margins drop. But please understand the entire pain is front-loaded for a bank, while the benefits come at a benign but extended period of time. The benefits come from pickup in liquidity and a reduction in interest rate differential, moving low-cost funds like checking accounts, current accounts at a faster pace, repricing of your term deposit portfolio, and all of that. So, that's where our positioning comes from, and definitely relative valuation and enthusiasm plays a role in making that distinction.
Interesting. We'll get on to the relative valuation argument in a short while, Santanu, but just bring it back to the banks. And conventional wisdom states that the banks are going to face pressure on net interest margins, given that cumulative 100 basis point reduction by the RBI since February and the possibility of more to come. So how long is that NIM compression going to last for? And when will bank margins find the floor and therefore earnings come back?
In our estimation, the margin bottom for most of the large banks should happen in the next quarter. So look, first of all, 50 basis points was not expected. Most people expected 25 basis points. The other 25 basis points was to come in Q2. All of that has come on June 7th, which means that really 23 days of impact is what we are seeing in the first quarter results that are just coming out. Typical repricing is anywhere between 1 to 3 months, right? So by the middle of second quarter, on a month-by-month basis, the bottom on spreads would have been reached. So second quarter onwards, you're going to see a benign margin tailwind. And you'd be surprised to know that we expect that by the time fourth quarter of the financial comes around, which is March 26, the margins for that might be, in many cases, equal to and slightly better than what fourth quarter of FY25 looked like. So margins stop being a headwind and become a tailwind as you exit FY26. And by then, hopefully, credit growth should pick up as well. Now,
yes.
The consensus number for credit growth at a system level is about 10.5 to 11%, depending on who you ask in India. But we are at 13, because I think that the market is severely underestimating, growth in retail, especially because FY25, the last 9 months, has set a fairly low base as
yes.
people pulled back heavily on unsecured loans and things like that.
Have you got, that's interesting, Santanu, and can you give us a little bit more colour and visibility on where you see credit and loan growth evolving now that the RBI has embarked on an easing cycle, and where then does that put loan to deposit ratios, and who's going to be the overall net beneficiary of an improvement in that particular vertical and metric? Is it going to be amongst the NBFCs or amongst the banks?
Right. So let me take the second part of the question first, which is related to the credit deposit or loan to deposit ratios. That I think is stop being a priority. And if you just look at RBI commentary from last year versus this year, you'll see mention of loan to deposit ratio has almost vanished. The LCR norms which have come out actually, this is the liquidity norms, have actually been a lot less onerous than what has been initially proposed. In short, you are seeing that the regulator is in favor of easing. And while easing, it's not only monetary and liquidity, we are talking about credit policy also they will want to ease. And if anything, there's every stimulus for banks to up their credit growth. Now, in terms of what constitutes credit growth for next year should answer the first part of your question. Look, I mean, we don't build in anything very aggressive for corporate loans. We understand that balance sheets, both on the industrial, manufacturer side, as well as the financing provider side, which is the banks, are as clean as they have been in the last 2 decades, right?
Yes.
Plenty of dry powder and all of that. But, given where global macro uncertainties are, for a promoter to take a leap of faith and go for higher cost bank financing, longer duration, large projects is not going to be very common. So practically speaking, we are building in only 6-7% kind of corporate loan growth for the system for this year. So basically what we are saying is, yes, there will be a case for a turnaround at some point, but I don't want to make it part of my investment thesis. The two
Santanu,
things we are relying.
Sorry, if I may, Santanu, your core thesis here is that you are feeling more constructive towards the banks because of a future improvement in banks' deposit ratios for current accounts and savings accounts, and you feel that there's a regulatory tailwind for CASA ratios. Am I correct in stating it that way?
Absolutely. And also the fact that at least 2 of the segments, which is SME as well as retail, SME and high growth and retail back to about 15% growth, should be plenty to deliver 13% system growth. And which means that top banks generally end up generating 200 to 250 basis points higher than that. HDFC Bank is a special case going through the transition, so probably it's going to match system growth. But the likes of ICICI, etc., should be able to outpace system growth by 200 to 250 basis points, especially given the competitive strengths that they now have. And that's what makes me constructive. If you work with that loan growth, and I'm saying that by the second half of this year, margins become a tailwind. You don't see too many clouds as far as asset quality or credit cost is concerned. Even if you don't get operating leverage, earnings growth becomes greater than equal to credit growth.
Santanu,
and that's a great setup.
Sorry, if I may, at what point does your thesis start to resonate in the markets? Because if you look at valuations, there still exists a valuation gap between a name like ICICI, which trades at a valuation discount. When is that going to start to narrow against the NBFCs, which do appear, to your point, fully priced?
Right. I mean, I think earnings momentum has played a strong role as far as valuation recognition is concerned in the last 2 years for the banking sector, right? Because if you look at things like balance sheet health, which were driving bank valuations, let's say, for the 3-4 years before that, when really balance sheet repair was ongoing for a lot of names, including ICICI Bank. Right now, it is about earnings momentum. So by the time margins turn a corner, I think that should be a catalyst for recognition of the earnings momentum going forward. And that should be third quarter. Yeah.
I see. So put it all together, Santanu. Give us more colour on what's informing your top picks on a 12-month basis, which are HDFC Bank, ICICI and Axis Bank amongst the large caps.
Right. So the valuation discount that I'm talking about vis-a-vis what we think is steady state is largest in HDFC. And that is not surprising given that, through the merger, its balance sheet has become higher cost, and the transition point in the merger, in terms of what they guided and what they delivered, there was a large gap, so some disappointment. But a part of that re-rating has happened as people realize that it's not exactly becoming a 10% ROE business. It's probably priced now as a 14 to 15% kind of ROE business. Our thesis is that it goes back to being a 17% ROE business, exactly like it was before the merger. Only the composition of that ROE is different in the sense that it is now a lower margin, but at the same time, lower operating cost business. As that re-rating happens, the re-rating potential in HDFC is significantly more than something like ICICI. Although in ICICI, we think some re-rating is possible. But ICICI is being recognized for its excellence a lot more than it was being, say, 1.5 or 2 years back. And the current numbers bear that out over the weekend, whatever they have reported. Apart from a couple of points here and there, there's really nothing to pick. Reported a set of numbers which reflects its leadership position. So it is, in some sense, my all-weather bet. The kind of bet where you are willing to accept a little less upside because it is a really low beta idea within that context. ICICI's beta, if you go by simple calculation based on market price, still appears far too low compared to what the beta should be given the current business model. Third pick, Axis, is my liability beta idea. And I have to be honest with you here, the last 2-3 quarters, it's more than good or bad. At the margin, things have been a little ugly, a little messy. Credit costs have come out a little higher than they should have. Growth slowdown has been a little steeper than it should have been. But the valuation comfort is there. And if I look at the balance sheet composition on an objective basis, it is, of course, highly geared to an easing cycle as far as cost of funds is concerned, given the amount of short-term money that it has. It is higher beta and perhaps one of the best ways to add beta right now. But I feel the pain that investors are going through, given the last 2-3 quarters, numbers haven't exactly panned out as per expectation.
Santanu, I know that you were abundantly clear about NBFCs being fully priced, but are there select opportunities there that are perhaps presenting reasonable value?
So look, we continue to prefer Bajaj Finance as the best idea. Earlier we were more bullish on it because, the same stock was trading at 6,300, 6,400, 630, 640 equivalent at today's price after split and bonus. And today it's re-rated almost 50-60% in the last 6 months, right? It is still a decent compounding idea. The fears around asset quality and the quibbling around whether the growth is 26% or 25% does not matter that much given, where the multiples are. And there's decent compounding available there. So unless someone has a different view than me in terms of, how asset quality or the next 5 years growth is going to be developing for this business, I see no case really for a valuation discomfort. If you vary on those fundamental ideas, then you can. So Bajaj Finance would be, my preferred idea within the NBFC pack very clearly.
Santanu, I know that there's still a lot of work to do from a balance sheet repair point of view for many of the banks, but do you like the story and the foreign ownership angle related to Yes Bank?
So we don't cover Yes Bank, but we always have an eye on every single player in the market in terms of for gauging the competitive dynamics of the business. And it is a rebuild process, and we are watching it closely as it develops. Just before you segued into our interview, you yourself were speaking about Sumitomo Mitsui trying to take a stake. So we'll watch those developments closely before we form a research view in a formal sense.
Understood. Santanu, it's been a pleasure talking to you, sir. Thank you very much indeed for that deep dive into the Indian banking sector. Santanu Chakrabarti there from BNP Paribas. Right, President Trump weighing in on the possibility of a BRICS currency and the economic bloc, warning the group that includes India, Russia and China would end quickly if they ever formed in a meaningful way.
The reserve currency is so important. We lost that would be like losing a world war. We can never let anyone play games with us, and that's why when I heard about this group from BRICS, 6 countries basically, I hit them very, very hard. And if they ever really form in a meaningful way, it will end very quickly. I will tell you for them. They won't be gone very long. I don't think they'll even do it. They're virtually afraid to meet. I also remain fully committed to my pledge never to allow the creation of a central bank digital currency in America. It won't happen.
Quick check on the energy complex, and let's give you the international oil benchmarks. WTI 67.46, Brent crude 69.35. India's refiner Nayara Energy is now in the crosshairs of the European Union's newest sanctions on Russian oil. The EU has cleared its 18th round of measures against Moscow over the war in Ukraine, including lower price caps and curbs on ships moving Russian crude. Russia's top oil producer, Rosneft, a key stakeholder in Nayara, has hit back, calling the sanctions unjustified, illegal and a threat to India's energy security. Coming up on the programme, a high-stakes election in Japan, making things tougher for Prime Minister Shigeru Ishiba on the trade front. How? We will tell you after a very short break. Welcome back. You're watching Inside India. Some of the stories that we're keeping tabs on today. South Korea's ex-president Yoon Suk-yeol has been indicted over additional criminal charges related to his declaration of martial law last December. Charges include abuse of power and the obstruction of special official duties, which means that he could remain in jail for up to 6 months. Prosecutors have already indicted Yoon on other charges, including masterminding a rebellion, which carries only 2 possible sentences: capital punishment or life imprisonment. CEO of Astronomer resigned over the weekend, just days after being caught on camera at a Coldplay concert. Nothing wrong with that. In a video that's gone viral on the internet. However, Andy Bryson is married, but could be seen cuddling in the kiss cam, quote unquote, with employee and chief people officer Kristen Cabot. In a statement, the tech company said leaders are expected to set the standard in conduct and accountability, and Byron did not meet it, evidently. Now, weeks before the new US tariff deadline of August the 1st, finance ministers and central bank chiefs of G20 wrapping up a key meeting, the group vowed to step up international policy coordination, push for global debt relief and scale up climate financing. They also stressed the importance of central bank independence. India's finance minister did not attend the summit, neither did US Treasury Secretary Scott Bessent. The United States will be taking over the group's rotating presidency in December. Now, let's head over to Tokyo, where Prime Minister Shigeru Ishiba is in a difficult position, to say the least, after his coalition's dismal performance at the upper house elections over the weekend. CNBC's Kaori Joji has the details and the implications, and carry deep implications for tariffs and for fiscal and monetary policy.
Yeah, I mean, I feel like this is a perfect storm with this historical defeat over the weekend in the upper house elections. Prime Minister Shigeru Ishiba is on very, very thin ice. His party, along with his coalition partner, the Komeito, failed to win a majority in the upper house. This means that they do not have a majority in the upper house and neither in the lower house. Both both houses of parliament, which means his room for maneuvering on any kind of policy action is severely restricted over the weeks coming up. He has put on a brave face and said last night, as the numbers were coming in, that, look, I'm prime minister. It is my responsibility to see these tariff negotiations through because this is a national crisis. He will be meeting the press at about 2 p.m. local, and no one is expecting an immediate resignation from the prime minister. But given the drubbing that they faced in this election and two back-to-back national elections in less than 1 year in office is unprecedented. This is a crisis of existential crisis for the LDP that they haven't seen since the party was formed in the 1950s. And the timing could not be worse because August 1st is coming around soon, and 25% tariffs will be detrimental not only to the auto sector but other sectors as well. And there are reports that Akazawa, the lead negotiator, is heading to Washington even as early as today for the 8th round of negotiations that basically gotten Japan nowhere. They didn't have leverage trade before this election. Who are they to think that they have anything to offer to the U.S. side, which they were in town Friday. They said they'd keep talking, but that was about it.
Carrie, is there anything under the Japanese constitution that may permit the Prime Minister to perhaps just stay on and complete a trade deal with the United States?
This election result does not necessarily have to mean that he resigns. He could stay on. It's not a direct representation here. He could decide to stay on by forming some kind of loose coalition that involves more than just the Komeito. I mean, the big winner in this election is the far right. The Sanseito in particular, which was a fringe outfit born out of YouTube 5 years ago, but now has won big and rode on this sort of Japan first sentiment and nationalist agenda. And then you had the Democratic Party for the People also veering towards the right, which did a lot better than initially expected. So in order to form such a grand coalition, he would have to concede to many of their demands, including fiscal expansion, consumption tax cuts, and so forth. And that's one of the main reasons why I say this could be a perfect storm brewing here in Japan trade.
Needs the support from the opposition party. It's fascinating to see on a global basis the rise of the far right. Thank you very much indeed for that, Kaori. Coming up on the programme, we will discuss investment opportunities in alternative assets and how foreign investors are looking at the Indian markets. Do stay with us. Welcome back. Indian Prime Minister Narendra Modi is set to visit the UK later this week. He is expected to formally ink the bilateral trade deal first announced in May. The pact could open up duty-free access for India's textile and EV exports into Britain, while the UK is likely to gain smoother market entry for whisky, cars and food products. Right, counting down to the market open in India, and it looks as though we are going to be pivoting around this 25,000 level. We left off at 24,968. Remember, we are in the thick of earnings season. On Friday's session, it was the IT names and the banks that somewhat disappointed, and that dragged down the benchmark dollar-rupee exchange rate at 86.23. Over the weekend, Indian crypto exchange CoinDCX lost $44 million to cyber theft. The exchange described it as a sophisticated attack targeting one of its internal operational accounts. The hackers stole digital assets, but CoinDCX said no customer funds were affected. This is the second time within a year that CoinDCX has suffered such a hack attack. An Indian market regulator, SEBI, has proposed letting mutual fund managers offer both value and contra funds. Previously, they had to pick just one. However, there will be certain conditions. The portfolios must differ by at least 50%. Value funds bet on the underdogs in the market. Contra funds swim against the market tide. This as mutual fund assets in India surged to a record $870 billion in June. SEBI is also seeking feedback on whether mutual funds should diversify leftover assets into gold, silver or even real estate. Speaking of gold, let's take a look at the precious metal. This is where it's trading, $3,354 an ounce. Now, let's talk more about alternative assets within the Indian context. I'm delighted to say that Srinivasan is joining me now, Managing Director at Kotak Alternate Asset Managers. Srini, welcome to the programme. It's fascinating to see how India's alternative asset landscape has evolved remarkably over the years beyond fixed deposits and gold and mutual funds. So in your opinion, what are the most compelling opportunities in this space?
Good morning to all of you. Yeah, I think right now when the industry really started maturing, when the new regulations came in, which is now called the Alternative Investment Fund Regulations. And I would probably think that, the first set of funds that were raised was funds that were investing in real estate. It coincided with the government's opening up of real estate investment for foreign investors. And as you know, real estate is a very significant component of the Indian savers' savings pool. And that went on to spawn other asset classes over a period of time, over the last nearly 20-odd years. Private equity was always there. It was called a venture capital industry in those days, but now it's matured, and we now have a variety of private equity funds operating in India. And the interesting part of it is that the domestic investors have really warmed up to alternative assets in the last, I would say, probably 6 or 7 years. Otherwise, it was dominated by global investors. And I think that's the big change. And this is a change that is likely to, continue to sort of tilt the balance with regard to, the global capital flow versus domestic capital flow.
Srini, we just before we came to you, we were talking about how SEBI has proposed changing the rules and regulations that govern the mutual funds. How are you approaching these changes to mutual fund regulations in the Indian markets, and to what degree does this unlock opportunities?
I think, there are two different sets of regulations. So the mutual fund regulation is one which covers the retail investor, and the alternative fund investment regulations covers the larger high net worth family office investors. As far as the mutual fund regulations go, obviously the market is maturing, and therefore the liquid mutual fund options for more retail investors. The regulator, which has always had a fantastic feedback mechanism to make new rules and regulations, have engaged with the industry. And these options that are now being put on the table for the mutual funds with regard to, for example, longer tenor dated paper or more retirement planning kind of options in the mutual fund industry just increases the menu of options for savers in India, and towards that end, I think it just indicates the maturing of the market. Similarly, in the alternative asset side, about 8 years ago, there were very few kind of opportunities. Now you have, venture debt companies, private credit, infrastructure, of course, not to speak of the real estate investment trust and
yes.
infrastructure investment trusts. All of those are, options now investors have in India.
Srini, how alternative is alternative in an environment where, again, we just touched on this story before we came to you. Coin DCX has suffered its second hack within a year. Would clients therefore be well advised to stay away or approach cryptocurrencies on a very selective, very cautious basis? What's your advice to the alternative investment crowd?
I think the general advice is, whether it is crypto or anything else, if you don't understand the underlying, stay away from it, and at least rely on somebody else who understands it better for you. If it means that you have to part with some of the economics for better understanding, that's probably the right way to go about doing it. Of course, truly spoken as a fund manager. Having said that, with regard to crypto specifically, I think there is a fair degree of skepticism in the Indian market in any case. The central bank regulator has been very, very cautious on the development of the crypto as an asset class per se. So it's very, very small component of some very select set of sophisticated investors who currently have an exposure to the crypto industry. So it's not material.
Yes.
It is still largely gold, mutual funds, and private credit funds and such like investments.
Srini, we've been reporting for quite some time now how high net worth individuals, Indian entrepreneurs, the wealthiest Indian citizens, and now increasingly the Indian middle class, they are emigrating to countries like the Emirates, though it's not quite capital flight, is it? Since many of them still have investments and businesses that remain in India. Is this a problem, or is this, in fact, a growing opportunity for asset managers? And how then are you looking to serve the NRI client base?
I think the NRI client base has always been a significant component of any investment product manager as well as a bank, for example, in India. As you know, India has the largest inward remittances from Indians living overseas. Last count, close to about $135 billion on an annual basis. It is one of the most significant components of foreign exchange inflows into the country. Insofar as people emigrating to some of these other geographies are concerned, I think it's more of a tax planning issue for the individuals concerned. But if you look at the corporates, for example, and I would just contrast it with what's happening in the startup industry, since you talked about the startup founders. Many of the startup industries were led to believe that domiciling the companies in other locations could be more beneficial for raising capital further going forward. Now we have a situation where there is a reverse migration of a number of those companies from other geographies back into India. So I guess, just like money will always move, like water, wherever it finds the best level, capital flows or people flows will be determined by external factors and, of course, their own personal priorities. In case of those companies, their priorities at that time was trying to raise global capital. Today, their priorities are to try and raise capital from the domestic market, in the public market, where companies which are India-focused are getting a better valuation.
India focus. I'm glad you mentioned that, Srini. And there's been something of a quiet revolution, hasn't there, in InvITs, infrastructure investment trusts. Is that a space that's been working for investors? And can I also just follow that up by asking you about the case for domestic India as it applies to the alternative assets complex, and how that all ties in to the longer-term goal of Viksit Bharat and this initiative aimed at India becoming a developed nation by the centennial year of its independence?
No, thank you for that. I think it's a great question at this point in time. REIT and InvIT regulations came in a few years ago, almost 6 or 7 years ago, and Blackstone now has 2 REITs in India, office REITs in India, and Asia's largest office REIT happens to be listed in India as a REIT. Insofar as InvITs, which are for infrastructure assets, are concerned, I think a fair amount of capital that has come in so far has been from global institutional investors largely to buy income-producing road assets, solar assets, and such like investments. But it's important to understand how the government and the regulators are thinking about domestic capital pools to also participate with equal vigor. Literally a few weeks ago, the regulator which controls the pension funds in India have given greater flexibility for the pension funds to invest in the InvIT market in India. And a similar exercise is on with the insurance pools of capital. Just to put this in context, with regard to the total amount of investments into InvITs in India, our own domestic pools of capital, whether it is family offices, pension funds, or insurance companies, comprise less than 5% of the total pool so far invested. So the counterbalance with regard to domestic pools of institutional money coming and participating in the InvIT market is just about beginning. To my mind, income-producing assets, which are stabilized cash flows for long tenures, are a great investment opportunity for these pools of capital. And what we could potentially see going forward is that the balance of the total capital that was available in, let's say, in the public markets, earlier it was all dominated by foreign institutional investors. Today, out of the public float, the majority of the public float is owned by domestic mutual funds, as the mutual fund industry expanded to, as you rightly put it earlier, $870 billion. You are likely to see something similar happening with regard to InvITs.
Understood. Srini,
one last thing I want to mention
please.
with regard to government policy. The government actually has rolled out a red carpet for global institutional investors, sovereign wealth funds, and pension funds, specifically investing in infrastructure in India, where they are tax exempt on their interest income and capital gains. And this is a very, very important driver for investments into these sectors.
Srini, brilliant conversation. It's fascinating. And I do hope that we could touch on private family offices, succession, estate planning, and how the next generation are positioning and what the flavour of allocation is. But perhaps we can do that in another conversation. Srini, thank you, sir. Srini Srinivasan from Kotak Alternate Asset Managers. Now then, travellers heading to the US may soon need to pay a hefty new visa fee to enter. CNBC's travel editor Monica Petrelli is here with more. Who does it apply to, Monica, and why?
That's right, Sri. So definitely looking like it's about to get more expensive for some to go to the U.S. So a provision of the One Big Beautiful Bill Act calls for what is called a visa integrity fee. And we know this is for anybody who requires a non-immigrant visa to enter. So this is business, leisure, coming from those countries that are not part of the visa waiver program. So that includes those from India, China, and much of Latin America. It's going to be at least $250. And it may be reimbursable. That's if you comply with the terms of your visa. Now, what we don't know is when it will start, how you will get your money back, but we can see that the Congressional Budget Office estimates that this will net the U.S. government around $29 billion. And a few of the reasons why is that it expects a lot of people won't ask for their money back. You don't get it until the visa expires. If you've got a 10-year visa, you may never remember to do that. And the other thing that we're seeing the Budget Office saying is that it may take years to get the reimbursement process going, which what I'm hearing from sources is that the fee may actually begin at the end of this year, but reimbursement's not for some time. That is not yet confirmed. The government not saying anything.
So a couple of questions here to unpack. Do these fees apply to long-term visas, student visas, short-term holiday ESTA visas? Because I remember when I go to the States, it's about $20, $21. And now we're talking about $250. And are travellers going to think twice before they put down that fee and maybe they won't even get a visa at the end of the day?
I think that's exactly what the industry is worried about. The travelers will think twice as to who it applies to. If you need a visa to go, so you're outside of that visa waiver program, then you do need to have this. This is on top of the visa fees that you'll already be paying. We're also seeing
do Indian travellers have to pay this?
Yes. So it's visas plus we're seeing the other fees going up too. ESTA has gone up, I-94 has gone up, but nothing like this $250. We're also seeing immigration lawyers saying that they're telling people right now to consider this not refundable, even though it says that it is. Some skepticism about this, saying maybe you should view it as a bonus. That's what one lawyer told me, if you can get your money back, especially if you have a visa that lasts for years. You simply might not remember or want to go through the trouble of getting the money back. But it's a very important point that you just said. Will this dissuade some travelers from going? I guess we'll have to see about that. We do know that the government does estimate about 1 to 2% of people do violate their visa by overstaying.
Yeah.
But a much larger percentage of people that are living in the U.S., the government expects or projects that are there from overstaying. So it looks like this is a visa to try to prevent people from overstaying. Whether it will achieve that goal, also yet to be seen.
Still, even if they are legitimate travellers, $250 is potentially something quite hard to forgo and write off, isn't it?
Especially for families.
Yeah, indeed, indeed. Thank you very much indeed for that, Monica. Right, Indian markets have joined the trading day with Reliance and HDFC going to determine the Nifty's trajectory. We will take a closer look after the short break. Welcome back. Let's give you the Indian markets, which are just coming online, and it's really earnings that are going to be calling the shots, as they have been doing for the past week or so. Nifty 50 at just a shade below 25,000. Dollar rupee at 86,325. Now, think of earnings season, as we said. Quick check on the shares of Reliance. This is the heavyweight. They are down by 2%. The Mukesh Ambani-led conglomerate reporting a 78% rise in Q1 profit, helped by strong growth across key businesses and a one-time gain from selling its stake in Asian Paints. Reliance's core oil-to-chemical segment saw a recovery in the April to June period, but it is facing risks ahead. New sanctions on buyers of Russian oil and vessels transporting it could hit the company in the current quarter. Reliance does have a long-term crude purchase contract with Russia's Rosneft. And private lenders HDFC and ICICI and Yes Bank getting a chance to react to earnings. All of them are up. HDFC leading. We were talking about this name with Santanu. It's one of his favourites, actually, despite some of the post-merger quibbles that it has to deal with. All three saw profits rise, but as we mentioned earlier, HDFC did see a rise in bad loan provisions and ICICI facing some margin pressure. JSW Steel reporting a stronger than expected Q1 profit as raw material costs eased, despite the profit beat. Company flagged concerns over rising low-cost steel imports from countries like China and Russia. Although steel prices in India improved quarter on quarter, they remained below last year's level. JSW Steel CEO called on the government to extend and increase the current 12% safeguard duty, warning that cheaper imports are weighing on industry sentiment. Shares currently trading at 1,025 rupees and some change, down by just under 1%. And German insurer Allianz has announced a 50-50 joint venture with Geo Financial. Allianz says it aims to strengthen its footprint in India's fast-growing insurance sector. Two firms have signed a non-binding agreement covering both general and life insurance operations. Geo Financial shares trading slightly lower, off by just a fractional 0.3%. Now, the EV race in India is heating up with the entry of Tesla and Vietnam's VinFast, and with multiple domestic players in the fray, price wars could take hold. China has been facing a similar situation for quite some time now. Elaine Yu joins us with a closer look. Hi, Elaine.
Hey, Sri. So we know now how price wars in China across various sectors are squeezing profit margins and shaking investor confidence. But how do consumers actually feel about that? And it sounds like on the surface, right, consumers who are more price sensitive would welcome this. But how are consumers actually impacted in this sort of price war? And actually, Beijing is taking action now. China is planning to ban the resale of cars within 6 months. That's after reports, including its front page state media article saying that brands like Zeekr and Neta have inflated sales to meet aggressive targets. So they do that by arranging for cars to be insured before they're sold, and that allows companies to book the sales early. And this is also after market regulators have summoned food delivery giants, urging them to compete, quote, rationally, and to build an ecosystem that works for everyone, from consumers to delivery workers to the platform companies themselves. That's after we've seen ultra cheap deals like coffee and bubble tea for mere cents. So the context is China is in its longest deflationary streak in decades. And when prices keep falling, that could lead to lower revenues and in turn wages being cut and even layoffs at companies. So we took a closer look at the price war in the EV industry, and specifically from a consumer's perspective. So let's take a look, and this is what we found. From cars to food delivery to solar panels, China's fierce price wars have become so intense, they've prompted even President Xi Jinping to speak up. Calling the trend disorderly, he wants tighter regulation. In the booming EV market, price cuts are rampant, eating into automakers' profits. But what does all this mean for consumers? Li Kun, a shopper in Beijing, says he was immediately hooked when an Xpeng salesperson called him about new discounts.
The harder the manufacturers compete, the better it is for the buyers. Compete however you want.
But cutthroat competition comes with hidden costs, with some buyer concerns that quality and safety can suffer when manufacturers cut corners to stay cheap. Timing a purchase could be another gamble, says Yu Peng, a customer in Beijing.
We say buy early, enjoy early. After you buy, the price might fluctuate. As a consumer, there's not much you can do except quietly accept it.
State media has been critical of these price wars, saying they hold back innovation while hurting wages and investment confidence. Recent commentary also slammed some local governments for what they call unfair incentives. Subsidies might be propping up the market, but companies are going all in to cultivate the brand loyalty key to keeping their customers. Chinese-Swedish carmaker Lynk & Co. is adding eye-catching features to stand out. Sales manager Jim Ma says the company's focus isn't on short-term profits, but winning trust over time.
Our pricing policy is meant to make customers like and choose our brand. In the long run, when they need after-sales services or decide to replace or buy a new car, we hope they'll still choose us.
The ripple effects of China's pricing battles are being felt abroad in varied ways. Some consumers outside China welcome the shakeup that forces automakers globally to offer better products. Advocacy group Transport and Environment says Chinese EVs helped fill the gap left by slow-moving European brands. And while consumers in Europe generally care more about quality than a car maker's origin, they also worry about broader economic impacts.
They just want to make sure that this does not result in, for example, their neighbor or someone in a nearby village losing their job.
The bottom line is, if the price war undercuts quality and innovation, consumers may end up paying a different kind of price. So falling prices could, of course, seem like a win for consumers who are price conscious, but the long-term trade-offs are really much more complicated, especially if these price wars eat into profits, product quality, innovation, and ultimately hurt income and contribute to China's deflationary environment, which Beijing now is watching very closely. And in the end, there may be no winners from a price war. And you can read more on CNBC.com. Back to you, Sri.
Fantastic report. Look forward to that. And I'll be reading that, Elaine. Thank you. That's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up with Access Middle East. Have a great week.